Thank you, yes, and thanks a lot for the invitation. So this is a work I think actually is very, it's just I think the goal of this research institute, because it's not only just finance or finance department, but it's also in the paper we use masters that also use computer science or computer science. So this is a joint work with my previous advisors for the Sharpe. So in this paper, we try to study mutual fund disclosure distribution learning. Right, so one motivations that we have for the paper was because, well, we just finished college. Everything back to the person at the beginning of college. For the market, it was real bad. So COVID-19 caused the increased market volatilities, and in some countries, the market in fact was closed for some time. And in fact, if you look at this graph, so this is the graph taken from one of the recent papers by Textual process. So basically, you found that just at the beginning of COVID, so there is huge net fund flow from U.S. mutual funds. So it's almost like $40 billion. So that's a huge outflow. Meaning that investors simply just withdraw their money from the mutual fund for a lot of reasons. So in this case, we know that under these unusual and fluctuating conditions, the institutional investors, especially mutual funds, they are just adversely affected in several ways. And one of the reasons they can be affected due to, for example, net fund flows is because of the strategic complementarities with the market, in the financial markets are fragile. So this is well documented in the finance literature. So the basic idea is that there could be a fund point. So just like the classic background theory that when some investors anticipate other investors to withdraw their money from the funds, so these investors, they can anticipate others' actions and they will just withdraw first, because if everybody is withdrawing, then the fund is subject to a lot of risks. For example, also parcel, that's another common negative impact on mutual funds when investors suddenly withdraw their fund or their money from the funds. Therefore, mutual fund just have to liquidate some of their stocks. There's nothing about information. If not, if they sell the stocks, it's not because the stocks are bad stock, bad investment. It's just because they have to sell, and so that they can give redemption to the mutual investors. So, and this is of course also ICC found that this can be a real issue. So in the past couple of years, ICC actually tried to implement different rules just to increase the risk management of mutual funds. And specifically, like at the end of last year, ICC even proposed new rules just to ask mutual funds to be more transparent, to provide more disclosure, and so therefore improve the risk management. So here, so we hope that we can also provide some policy implications to the regulators. All right, so in other words, now we know that risk management is really important. Right? So probably that, well, we know little about the mutual fund manager, how they view the risk. And we know that, well, they will manage risk, but how do they view risk? Do they think risk is a good thing or a bad thing? And specifically, we're curious about the forward-looking assessment of risk, because if you want to know for example, the manager, how the manager, manage the fund's risk in the past, we can just look at some quantitative information, because there are a lot of disclosure on quantitative information such as the past performance, past holdings, which have been well studied by researchers, investors, and analysts. So this quantitative information is not new, but the problem or shortcoming of this information is that they are just about the past, which is not about forward-looking. And we're just curious about managers forward-looking assessment. So therefore, we go to one critical SEC mandatory report, which is the mutual fund shareholder report. And so in this report, the mutual managers, they provide their subjective opinions on different topics, and which often include risk assessment. Right? So in fact, there are 100,000 disclosure every year. So in fact, I just randomly like one file in my sample, and it happens to be the shareholder reports written by Tim Buckley, the chairman of Vanguard. And we can see that. So basically, here is a short discussion by him. It's a little bit hard to see. But I'll just read the first two sentences. So Tim Buckley says, recent volatility in financial markets affecting stocks, bonds, and commodities has been a good reminder of the wise old adage. Never keep all your eggs in one basket. Maintaining balance and diversification in your investment portfolio can help to both limit risk and set you up for long-term success. So you can see that, well, in just this, probably just one sentence or two sentences, mentioning volatility, limit risk. So in other words, this paragraph provides his opinion, his assessment on risk. And so therefore, we have hundreds of thousands of these disclosures that may or may not be about risk assessment, and we're going to try to extract risk assessment from these disclosures. And so in other words, our study is built on the textual discussions from managers. And specifically, we try to tackle a couple of questions in the paper. First, can deep learning capture managers' narrative risk assessment that reflect their future risk taking? Well, the reason that we want to use deep learning is that, well, there are just too many disclosures. It's impossible for human to read all the disclosures. So we want to use machine or machine learning, everything to capture this information. And then we also ask that whether the forward-looking risk assessments are associated with the fund skill or better performance in the future. So this is what the investor will hear, even if in other words, we can construct some measures to gauge the risk assessment. But why do investors care? Why do they care? Because they can reflect the measures fund skill. And if so, what is the source of their skill? Our question that we ask. Finally, we also curious about, well, since these disclosures, as you can see, dear shareholders, so these are shareholder reports that are addressed to investors. So investors are the recipients, and are they able to respond to the manager's natural risk assessment? So this is another question we want to tackle in this paper. And so we believe that this paper is related to several strands of the literature. So first of all, it's related with mutual fund risk-taking literature. So there are a lot of papers that goes back to the 1990s, but all of these papers use the content information that we mentioned. So one thing we're different with their study is that we try to develop the tax-based risk assessment measures that can predict the future risk-taking, future performance. And we're also fit into the literature on textual analysis with advanced deep learning techniques. So in recent finance studies, so there a lot of people try to use different machine learning techniques to study, for example, conference call transcripts, the 10K and 10Q disclosures, the news articles. So we just study a little bit different context, which is a managerial reports. We try to identify the manager's tone towards risk. And finally, there are also several contemporaneous papers that are also on the mutual fund disclosure, so which also focus on the tax data. One thing that we're different from theirs is that we focus on different set of mutual fund disclosures. So these papers use the fund prospectus or the shareholder reports. So these two filings still have some differences, although they're both symmetric filings, but they have different contents in the filings. Specifically, that we chose shareholder reports because, for example, this example that I just showed you, that it is more about the manager, their view for a certain period. for example, this funding is felt semi-annually. So in other words, this discussion only for the next month or the past 6 months. The prospectus can be for a longer term. So we want to capture the temporary risk assessment. All right, so here are some just preview of the results. So first of all, we employ the deep learning models, which can help us extract the relevant information from disclosure, and so we are able to construct the forward-looking risk assessment measures. And then we found that these measures act actually on their own risk assessment. Right? This is not adjusting their future risk taking. So in other words, if they believe risk is a good thing, they will increase their risk taking. If they believe risk may be a bad thing, they will reduce risk taking. And then we found that role managers who are cautious about negative risk, so who really don't believe risk is always a good thing, they are also able to generate higher performance, which are measured by risk-adjusted return, the Sharpe ratio, as well as Morningstar ratings. And we also find that these measures tend to be skills, they're also less overconfident. And they're also able to anticipate the future market uncertainties so that they can work with downside risk. And lastly, we also find that not only investors respond to this disclosure, only the sophisticated investors, they are able to recognize different measures for the success. So in other words, we hope that our strategy also provides some insights to the retail investors or less sophisticated investors. All right, so here so there are a lot of data that we use in this paper. So the primary data sources, what I mentioned, the mutual fund shareholder reports, and so these reports are contained in the SEC from the CSR. And we use a combination of computer program and many work to extract these reports from 2006 to 2018. And this is because there is no template or clear cut for this section. So therefore, we wrote like a computer algorithm to locate that part and explain where to pick up what's the information. Otherwise, the value can be really lengthy and contains a lot of noisy information. And so there are also some fund level variables which we take from just the standard databases for mutual fund research. First, mutual fund or the fast-free mutual fund database. And we also use data from Thomson Reuters as well as Morningstars. So this is the standard in the literature. And because this is, so essentially this is also studied on textual analysis. So therefore, we also construct a risk diction, which contains just risk-related words. And this is a word, it contains almost 400 words, and we compiled this dictionary by using 2 recent papers. One is the list of synonyms of risk in the hashtag all 2019, and also in plastic McDonald's, the local McDonald's, in addition to the negative and positive prediction, which are used by researchers. They also have a prediction of risk words. So just combine this risk words from these 2 studies so that we know when mutual manager they're talking about risk. And also to just gauge whether their risk assessment is positive or negative. We also use the McDonald's dictionaries of negative and positive words. So our sample period, essentially that's a 13-year span. So we eventually use more than 26,000 shareholder reports by active domestic active funds. So these are all US domestic funds. We also exclude passive funds, index funds. All right, so the first challenge that we faced, we kind of mentioned a little bit, or there was no clear transaction. There was also no template. So unlike other SEC coders, such as the firms which are like 10K and PQ, SEC provides a template and firms often follow. So this mutual shareholder report is really unstructured data. And we want to also pinpoint the mutual managers discussion. So how do we extract intrinsic information, semantic features from these discussion, especially want to go beyond the meanings of words. And in the past, so type analysis in finance is not new. So for that decade ago, people started to use type analysis in finance, but most people just use the traditional bag of words approach. So in other words, you just count the frequency of the words. And the problem is that the bag of words approach has something can only have other interactive features among words. So nowadays we have a lot of large language models, but so we know that bag of words are outdated. And also measures they can discuss their risk assessment in the different linguistic styles. So therefore, we can difficult to identify the patterns within ways of approach. So therefore, apply a deep neural network-based model. So this is actually developed by one of the computer science researchers, Zhang, in 2014, and we then used their model to analyze the relation between every pair of words in a sentence. So then, based on this model, we are able to construct directional risk assessment measures just based on relation between any of the two given words. So, just want to give you an idea about what this, what the neural network model can help capture. So this illustrations. So let's consider a very simple example that the risk is good, market is bad. So if one would use the traditional bag of words approach, which considers and the traditional bag of words approach, we consider measures assessment to be inaccurate because we can find there's an active word bad. But as human reader, you can easily tell that this bad is not about risk. It's just the bad is used to describe the market. So we still don't know whether this, suppose this is a right manager. We still don't know whether this manager risk is good or not. It's just the works. So therefore, the deep learning can help us with this task. And so this is example, and in fact, so their research, China language research, later developed into the Stanford dependency cluster, which is what we use here. So this is also an example that the Stanford dependency cluster can do. All right, so you can see for any given word in this sentence, if we have some intrinsic relation in this sentence in terms of the meaning of these words, the relation of these words, you can see that the dependency cluster can tell you that the relation between these words, for example, good and bad is conjecture and linked by this but. And also we can see that here good is used to describe risk and bad is used to describe market. And then we see that bad and risk, there is no direct relation between these two words. So in other words, so this dependency cluster to some extent that the sentence more like a human being. So it tells us that good describes risk, but bad does not. So in this case, the manager's assessment on risk is in fact positive. is not negative. So in other words, you can see that, well, if we use traditional vector approach, it can give inaccurate information or even wrong information. And there are also some other advantages of this learning model. And so, for example, what if because this is a really, really simple example. No manager would actually write a story like this. And often they will write complicated sentences. So if that's the case, so this is just a little bit more comprehensive sentence. This is just a little bit more complicated sentence. So maybe we can measure we have different writing styles, or we can write very long sentence. So therefore, is a model still accurate for different writing style or even for very long sentence? The answer is yes, because this deep learning model can actually capture with more complicated sentence. And this is another example that, well, set the risk, which will be reduced, is essential for our portfolio. So in this case, we know that it's cumulative level, which refers to risk. This is for reference linguistic. And then we said, well, it's in fact, its risk will be reduced. And we can see that will reduce and risk. There is not also a direct relation between these two words. So we know that will reduce actually describes the risk. So that in this case, the manager's risk assessment is also accurate. And also another very common that we're going to use double negation, not only in disclosure, but also in just our personal conversation in daily life. So, and sometimes some methods may not capture this double negation. In this case, the risk is not good. So we may only see this keyword good. But in fact, if we consider double negation, we know that what is in fact is that. So in this case, manager's assessment of risk is in fact negative, although there is no negative word at all in this sentence. So yes.
Yeah, I would like to get a better idea of how to defend like the song of clinical fact in terms of risk.
So yes, so just want to make sure that I follow your question. So you asked like how do we tell whether I say this word whether this is positive or negative?
Yes, essentially how what do we consider as an expression of positive or negative attitude?
Thanks for the question. So so I actually have been more clear about the data part is here. And as you can see that we actually use two sets of dictionaries. Now, in the first set of dictionaries, so this essentially is just a risk-related words. So in other words, we can locate when the managers are talking about risk. And then the second case is the second set of dictionaries here. So the dominant dictionary is on negative and positive words. So in other words, let's say the bad is would be in the negative dictionary, and good, of course, that's a positive word because LM dictionary. So if I use this dictionary, then it's used not only in the finance literature, they're also used by practitioners. So it's just readily used in our community. So therefore, in this case, this is the risk word. This is the LM negative word. So we use all of it. It's negative. This is risk. So the risk assessment. Did I answer your question?
Yes, I see. So yeah,
go ahead. I have and I'm sorry if I interrupt again, but I take this opportunity so we don't interrupt you so many times. Is this model I understand makes the grammatical link with different things. And what happens at the beginning of the sentence? You have, for instance, this bad. Then maybe it will reverse everything, and I don't see how it will impact the graphics here.
So that's super good question, because this bad, you can insert that's basically like a double negation. Right. So if we have this past and then a positive sentence, and then some positive words, we know it's in fact it's a negative sentiment. Right. So this fact, which this is why we can see this remodel, because it can capture a lot of different, because using this fact at the beginning, that's like a different writing style. So it falls under the double negation category, which can be captured. So that's a very good example. Maybe we can actually find whether one measure from our sample is whether indeed we talk about this and in the disclosure that comes from that technology to capture. I will figure out we have a little for this on is addition words. As long as there's an additional words. And it's also linked with us. We insert the double addition which words for addition based on these dictionary. That's the question. And so then, right, so basically we have two separate dictions. And then from this model, we can know the relation between, like whether there exists a relation between any two words. So then here comes the key measure in this paper. So we actually want to define a so-called net risk or negative risk and positive risk. So negative risk that the manager will have negative assessment risk and positive risk that we have positive assessment risk. So how do we construct this measure? So first, we count the number of negative risk pair. And how does this define? How it is defined? It is the number of pairs with one negative LN word. So the LN dictionary negative word. And let's see negative risk pair first. So in each pair, one word is negative LN. And the other word is a risk-related word. Then we consider this as the negative risk pair. So we actually, in this example, we have risk, this is risk word, and this reduces as a negative word. So in this case, we can count this as one, because risk and reduce the kind of direct relation. There exists a grammatic relation in the sentence. And so at the same time, we also construct the number of positive risk pair. So similar. For example, here we have a positive word good, we have risk word. And so we see that well, there exists a relation between these two words. So here, this is a positive pair. So then this eventually we do it on the document level, but not sentence level. So we just aggregate the number of pairs with negative or positive words. The other word is the risk word, the number of pairs. And also because some managers they can write long, some just really short discussions. So we also scale the number of pairs by the length of the document. And here it does the number of words. And at the same time, so in other words, so these measures they are deep learning based because the number of negative or positive risk pairs are detected and extracted by the deep learning model. And at the same time, because one thing, of course, want to show is that, well, the bag-of-words approach, we fail to capture what we want to capture here. Because otherwise, when we move for deep learning. So therefore, we also force raise with some simple measure based on the traditional bag-of-words approach. So here, for example, we create another variable called risk words. So this is just the frequency of risk words. So these risk words also come from the previous risk dictionary that we compiled, which was to make a fair comparison. We also scale the number of risk words by the length. Similarly, we construct the negative sentiment, positive our sentiments. And these are just also the word counts divided by this. In other words, these measures, they are often used in the past by people who work on term process analysis. They will just propose more accurate and better measures to show that our measures are superior than distribution measures. And before we go to the formal analysis, also want to show a piece of anecdotal evidence. So these are the actual disclosures, the actual disclosed sentences from our sampling. The first question is that, well, so we have these two key measures, net risk and cost risk. Are they really forward-looking risk measures? So therefore, we just go to the disclosure itself. And in this case, so the first example, this is disclosed by APN, Strategic Capital Absolute Return Fund. This is from their filing May 2018, in our sample. And so here we see a measure talks about a careful selection of complementary asset classes and inclusion in your portfolio against excessive volatility. So using our methodology, so this will be classified as negative risk assessment. And when we look at the future risk taking, we see that the measure of this fund, they reduce the risk taking of the funds after their disclosure. So after May 18, and they reduce their entire funds by 63 basis points. And we also have another example. So this is actually filed by Vanguard Growth Fund. So it's also written in October 2017. So the fund manager said that, well, that should power through a variety of economic or market scenarios and whose stock presents attractive risk-reward opportunities. So in this case, we also have risk-related words. It's actually the risk itself. In fact, the risk is most common risk-related words in all disclosure. The second being volatility. There are some other words with similar meanings. So, and we also have here this attractive. So attractive is a positive word from the LN dictionary. So in other words, in this case, the measures they have a positive risk assessment on the risk. So, and then we look at a subsequent risk taking. This fund actually increased their risk taking a lot. It increased the risk taking by almost 8%. In the next period. Now, here also, by the way, so when we measure the risk taking, measure the return, we also use the frequency of the shareholder reports. The shareholder reports are filed semi-annually. So when we measure the risk, and later show something about performance, this is also measured over 6 months horizon. Yes.
I have two questions. One is related to your textual methods. Here you talk about the risk, right? In your setting book here, do you distinguish like the sector-specific risk or general macroeconomic risk? Because in the number with the shareholder report, in the report, if the mutual fund is focused on certain sectors. And before that, they talk about the general economic risk, for example. And this sector could be correlated positively or negatively to the macroeconomic risk. And in that case, I mean, if the fund is focused on certain sector, and then they talk about the general economic risk, which is the opposite of the sector risk. In that sense, you're going to have some noisy measure of the risk because you have different type of risk, and the fund is focused on a sector-specific risk in that sense.
Yeah. So first of all, I think that's a great question, and it's it could be possible that because we know that there are a lot of sector funds. But one thing I think, so in our paper, actually, I think we checked, so I forgot to mention this, but I think we have excluded the sector funds. So in other words, we look at these funds that invest in the overall stock market and not limited in some just like one or two sectors. Therefore, in our sample, we're not subject to the compulsion that you mentioned that if you have different opinion on the entire market versus just one specific sector. But that's still a good question because we also have we also have another related paper, right? I think in that paper we didn't exclude the sector fund, and in that case, I think, and so in that paper I think we were able to also consider, for example, here it's not about just risk, but also to look at the tax exposure and to look at whether this fund has some opinions, whether it's on just a certain factor or it's about the entire market. I think so. Your comment is still valid because that's very, very possible. So I think in the other paper, there's a different actually how the difference between sector versus income market. But in this case, I believe we have excluded the sector funds.
Okay, the target is the topic itself is like the general economic condition kind.
Yes. So therefore, in most of the cases, because I also personally browsed a couple of these findings, and I think most of them they talk about the overall market.
The second one is related to the technical aspect. Here, if I understand you well, you propose a new kind of sophisticated way to evaluate the tone of the manager, right? But here you consider it as alpha or the data is part of alpha of the manager.
Yes. So later we should I'll show you the results on the like R.
And their perception about the risk. So here you said it's bad risk and good risk. But for me, it's hard to understand the good risk. I think that when the manager looks at the risk, they also look at the reward. That's why even second attractive risk to reward ratio. So I don't know if you only focus on the risk, the good risk. Can I interpret the good risk as the good reward, the Sharpe ratio, something the ratio given the risk and the reward they will get. I think in that sense. So it's positive risk is kind of
yes, so you see that positive risk it may not be good or bad, and the negative risk may not be good or bad. So we actually don't know. So that's actually a good question. So that's actually so I think you're asking a question that I will show later. So maybe I defer this question and then we can see some of the results because we do have some look at the positive and negative risk and how the manager respond and how their performance will be. Because like you said, risk itself, right? It's high risk also like so the first thing that I teach undergraduate finance class. The first thing that obviously is that fundamentally in finance, if you take high risk, you expect a return. So that so good risk doesn't mean that it's bad. So they will see that like why some managers their risk assessment can have an issue with performance. Right, so here I just give you some anecdotal evidence, and then here we do some like formal analysis, we just regress the future risk, and two measures that we propose as well as some traditional level risk measures, and so we can see that if the measure they have a negative risk assessment, then they will reduce their portfolio risk in subsequent period. We observe consistent negative sign on provision for negative risk. And at the same time, if the managers, if they believe that risk is a good thing, we will see that they will actually increase risk taking subsequently. So looking at the And also, by the way, so these different specifications, you can see that also we in some specifications that we do not have fixed effects, and in some we do have. And so the problem is the traditional governance approach is that, well, when we ask for remove the fixed effects, sometimes they just opt the results. So it means that they just cannot capture the actual risk assessment accurately. So this is why we learned that our measures are just better. And this is why how we justify that we want to use deep learning. So then, second question that, well, can deep learning based measures, measures and calculus, they help extract valuable information from measures distribution. So in this case, we also examine the future performance of these stems. And so specifically, we use the risk-adjusted returns. It's based on the sum of branch surfactor alpha and 6 alpha. We also use the Zhang surfactor model to calculate another alpha. So in addition to risk-adjusted returns, we also use the Sharpe ratio to measure performance. So here are the results. So the big idea, the big finding is that, well, some managers, who are cautious about negative risk, so because they have negative assessment. So these managers, they are able to generate better risk-adjusted returns. And this is true for different factor models. But at the same time, we see that, well, if the managers, they have positive risk assessment, they cannot deliver better performance. And in fact, in some cases, they can even have worse performance. So I think this is kind of related to the question. So therefore, of course, we want to take a deeper look into the difference between negative and positive risk. So this is the result for Sharpe ratio. This is very similar as the risk-adjusted returns. So therefore, the question that we have that, well, why only the managers with negative risk assessment, why only they can outperform, why not these guys who have positive risk assessment? So we have several conjectures. So first is that, well, in corporate finance literature, people often find that, the negative sentiment in exposure is more common than positive sentiment. So in other words, even for fund managers, if you want to avoid negative words, you still want to use more positive words, unless you really need to use these negative words. So this is one reason we believe, well, negative sentiment may just be more informative than corporate finance literature. And another hypothesis that we have is that, well, the positive risk assessments can reflect the fund managers' overconfidence, because managers who take a higher risk, they can be risk averse, and they can be very confident that they can do well. So this is just because the positive risk and return trade-off. So if they are very overconfident, then they may just take abnormally higher risk. But then at the same time, the literature has documented that, well, overconfidence is actually not good. Overconfidence can often lead to poor performance. And we also want to see that, well, whether these risk assessment are related with managerial skill. So here we use actually one measure of managerial skill from the mutual fund literature. So it is measured as return gap proposed. Told the CL manager there in 2008 RFS paper. So here we cannot look at the determinants of these assessments to see what kind of fund characteristics or manager characteristics are related with risk assessment. And one thing that we found is that for negative risk, we see that the scale as measured by the past return gap. So the return gap that will naturally have some of the action that can bring to performance. This is what we find from the original paper. So here in this table we found that, well, most skilled managers they are more likely to have negative risk assessment, but they are not more likely to have positive risk assessment. And at the same time, we see that overconfident managers, they are not going to have negative risk assessment. Or, in other words, the managers who have negative risk assessment, they are often not overconfident. So this can be the reason that we observe good performance for managers who are cautious about risk, in other words, who have negative risk assessment, but not better performance for those who have positive risk assessment. And we also try to see that, well, whether these risk assessments are related with skill. So again, we use the return gap as a measure for skill. So here we break down the sample into two groups: a group with positive return gap and a group with negative return gap. So with positive return gap means that, well, so maybe if you're not familiar with the neutral literature, so maybe let me explain this return gap as well. So this return gap is defined as the return reported by the mutual fund. So the mutual fund will report without like monthly return with some of their portfolio. At the same time, mutual fund, they also, each quarter, they also need to disclose their holdings. So in other words, we are able to calculate two returns from the mutual fund disclosure. So one is just the return that investors get, that's the mutual fund net return. And the other is that we can infer from the mutual fund manager's holding. We can calculate based on this holding, based on the stock that they hold, we can also calculate return. So this is holdings return. And there could be a difference between the reported return and holdings return. And if there is a difference, especially if the mutual fund reported return is greater than holdings return, it means that, well, there are some, because these holdings, they are reported every quarter. So in other words, within a quarter, maybe the managers, they are able to trade some good stock, and maybe they can make some good trades. So therefore, they can have a better return to the investors. So therefore, the positive return gap means that, well, the managers can deliver better performance than the holdings would suggest. And that means that, well, the manager, they're just doing a job. Just keep their holdings, achieve a better performance. So return gap is just what they use actual skill in mutual fund literature. All right, so in other words, in this case, column 1 and column 3, these are more skilled managers, while 2 and 4, they are not managers but not skilled. And we see that well, for the first two columns about the risk taking, we see that, well, for both set of both groups, they will reduce their risk taking when they have active risk assessment, and they will increase their risk when they have positive risk assessment. But one thing we can observe is that when we have negative risk assessment, the skilled group, they will reduce even more. So we look at the difference between the two coefficients. We'll also do some formal tasks to look for the difference in the coefficients. So here, this number, it suggests that, well, the most skilled measures, they're going to reduce the risk taking even more when they have negative risk assessment. And then, if we look at the performance, here, this alpha is a number for survivor alpha. And so we see that, well, if they're skilled, and then when they have negative risk assessment, that we can deliver better performance. And if they're not skilled, even if they have negative risk assessment, they still cannot deliver good performance. All right, so therefore, so I think this is related to your earlier question. So we therefore kind of curious about what is the source of their outperformance. How do we achieve better performance? Because so typically, if we consider positive risk return trade-off, if they take high risk, they should have better performance. But why this measure reduce risk they can in fact have better performance. So therefore, we want to, study the source of this superior performance. And one of these hypotheses that we have is that, well, it could be because these managers, they can anticipate the future market uncertainty or declines. So therefore, before the market is going to be in a volatile state, they reduce the risk. So therefore, when the market is uncertain or have abnormally high on the volatilities, these managers, they can avoid investing in risky stocks in these times. And also in recent paper, and also they found that the fund manager, they actually care about the downside risk, and they actually use downside risk to boost their performance. So similarly, we want to see that whether in our case, is downside risk factor that affects manager decision and or factor that brings the better performance. So therefore, we consider how fund manager can manage their downside beta. And this downside beta measures exposure to the downside risk of the market. And here we actually look at the holdings of these mutual funds, and we look at both the entire portfolio and all the stocks that we hold. We also look at their active trades. The entire portfolio, maybe the manager didn't, trade, any stocks, but because the underlying downside risk for the individual stocks change, so that we can have a lower or higher risk. So we also look at active trades. And specifically, we look at the large active trades, which the large active trades that will is the trades accounts for more than 1% of their assets under management. Because only large trades can really affect downside beta of their entire funds. Right. So here's the result that we can see that, well, when managers, when they have an active risk assessment, they will actually reduce the future downside beta. They will reduce the downside beta for their entire portfolio, right? Or if you look at their rebuy and new stocks, see that, well, they're going to buy stocks with low downside beta, they're going to sell stocks with high downside beta. So in that case, they can effectively reduce the downside beta of their entire funds. So therefore, we believe that fund managers with active risk assessment, they are those who can see the dark clouds in the sky, and therefore manage their portfolio with more caution, therefore deliver better performance on specific level. So the next question that we have is that, well, whether the investors, whether the investment community apprehend the managerial risk assessment. In other words, these are public disclosure, but do public really understand what managers are talking about? So first we look at the professional investment community, which we actually use the multi-star rating to see well whether this investment community responds to the manager's disclosure. And we use multi-star rating because in some risk studies, people find that multi-star rating is a very essential signal for the neutral investors. And at the same time, when we go to the methodology for multi-star rating, we also say that multi-star actually calculate so-called multi-star risk. It's also the multi-stars their own measure of the risk taking of the fund portfolio. So the multi-star rating actually considers the investor's risk aversion, which they use multi-star risk to measure. So therefore, in other words, we have an alternative measure for the risk taking. And I forgot to mention how we measure risk because that's a standard deviation of the fund return over 6 months horizon. So this is just alternative measure for risk, for future risk taking. And so therefore, we project that, well, managers with a different risk assessment, they can actually adjust this risk component so that they can achieve a higher multi-star rating. And so here, we basically confirm our hypothesis that, first of all, we see that, well, if we measure the risk taking by only starters. The measures for negative risk assessment, they also reduce multi-star risk. And at the same time, by doing so, you can somehow increase their multi-star rating. So these risk cautious managers can adjust their thinking so that they can receive a higher multi-star rating, which is rated by multi-star, and often higher rating funds they can attract the flows. So to some extent, investment community can respond to the new fund managers' exposure. And then finally, we also want to see, well, do all the investors understand what are disclosed in the mutual shareholder reports? So therefore, we do some flow tests to just examine how the mutual flows respond to the manager's disclosure, differentially for retail and sophisticated investors. And here we define the fund that sell shares through brokers as funds with retail investors. We create a variable called sophisticated. If these funds sell their shares through brokers, we label this variable as 0 because investors who buy through brokers, they're often retail investors. They also may not have enough financial literacy to buy from their brokers, or their brokers can give them advice on which funds to invest. At the same time, there are also some funds that just sell directly to investors. So if we consider funds that sell directly to investors as funds with sophisticated investors, because if you're these investors, you have to understand what these funds are investing, what kind of risk associated with the funds are investing. So these investors need to know they have more financial knowledge, and we look for the variable as one. So then we interact this variable with the risk assessment measures, and we see that, well, if we see that only the funds with sophisticated investors, they are able to recognize the manager's risk assessment skill. Just to look at the interaction here, you see passive version of the interaction. So in that graph, the mutual fund manager they disclose factor risk. If the investors are not sophisticated, then the investors will not respond, or they may even have negative flows. So you may even withdraw their money from the accounts. But if the investors are sophisticated investors, they will give more flows to the mutual fund manager. That's why we observe passive provision on the interaction term. So therefore, we believe that, well, maybe retail investors should also consider reading these mutual disclosure so that can give you an idea about whether your fund manager or if the mutual fund that you consider investing, whether their managers can be skilled. We also do a couple of robustness tests. For example, we use a so-called rule-based risk assessment measure. So this still comes to pass and level. In finance, people sometimes often ask, well, why do you use machine learning? We also want to see that, well, machine learning just helps us better capture the information. And here we also create another rule-based measure. So that's the number of that given other words here within 10 words conflict with word. So this is a more advanced method than the traditional better words approach, but this didn't employ any machine learning algorithms. So we can see that, well, they can confirm that our measures consistently capture risk and performance while the other measures just couldn't. And another thing that we did is, well, for the entire paper, we looked at positive and negative risk assessment separately. What else we construct is one single index. So we call this net risk. So this is negative minus positive risk assessment. So we consider those risk assessment altogether. We see that this can confirm our finding. So in conclusion, so We use deep learning to extract the implicit features on mutual fund managers' narrative discussions, and we're able to construct a forward-looking risk assessment measures. And we found that well, these measures act upon their words, they're not cheap talk. They actually just have consistent actions based on their exposure to the mutual fund investors. And we also found that all these measures were cautious about negative risk. They are able to, provide higher abnormal returns to the investors. Higher Sharpe ratio, they receive higher Morningstar rating. We also built that these new measures can inform investors about mutual management risk management as well as their investment decisions. That's all about the paper.
Thanks a lot.